the CFO of Zen Ledger. We simplify crypto taxes with software. And it's an honor and a pleasure to have Justin Macari of MacTax. He's a CPA and a business partner of ours, and we've frankly needed him to survive this season. We've had tons of questions from individuals, businesses, enterprises, all wanting to know how they can better their situation and file their taxes on time and accurately. So, Justin, I'll let you introduce yourself further.
Jonte, pleasure to be with you here. My name is Justin Macari, Zen Ledger tax professional, helping their clients from the CPA side of things prepare, organize their taxes, make sure that the crypto tax obligations, whether for business or personal, gets filed. MacTax CPA is my firm. We do business taxes, personal taxes, NFT crypto taxes, financials for people. And lately I've been diving in headfirst and trying to help put out content and educate everyone here on NFT crypto taxes, as it's a big emerging area and here to stay.
Great. So we'll dive in, assuming that the listener here is generally versed in crypto, but we'll try to explain along the way, especially certain themes or specific language, as we're effectively kind of wading through finance, right? Taxes, finance is always kind of full of jargon, and we'll try to demystify some of that. So maybe to start off, businesses transacting in crypto, it's not necessarily a straightforward journey, especially with incomes and losses based upon the date received, the date spent, the date bought, sold. And so are there any familiar pain points that you see from businesses, and how do we help to streamline and ease those pain points?
Yeah, so that's a great point. And businesses transacting in crypto, and businesses, whether you're an independent contractor, you received a payment in crypto, or you run a business in the crypto space, or you run a regular business and got paid with crypto, you have to, whether you're in any of those situations and your business received crypto, you have to consider all the income tax obligations that come with it. There's a big misconception out there that, as long as I never sold it, as long as I never sold my crypto, I don't have to report anything. Well, the very first question on the 1040 is, did you buy, sell, or receive any crypto for the year? The only exclusion is if you bought it with US dollars and you didn't sell it. But if you're a business and you receive crypto, you report the income on that date at the fair market value of that crypto on the date you received it. So what is that in layman's terms? Let's say you received one Bitcoin at $20,000. That's $20,000 of ordinary income, gross receipts for your business. Has nothing to do with Bitcoin, goes up, down, sideways after that. At that moment, you recognize the US dollar value for your business income.
I love those playbook points, and that's super important as it relates to knowing the timestamp. Let's talk about the 1040 that you mentioned. The IRS, like many regulatory bodies, and we've seen this all over the news in the past few days and months, have effectively prioritized crypto compliance. And they've also prioritized understanding who's in market and what the flows are. And so that question on the 1040 is relatively new, and it's evolved over time. Are you seeing folks ask questions about, for example, gifting or receipt of cryptocurrency via airdrops, et cetera?
Yeah, definitely seeing a lot of those. They keep it very vague, kind of on purpose. They want to, I tell my clients, they want to see who is playing on the honor system and who is not. And they're getting to that right away by making that the very first question on the return after you fill in your name and your social security number. And the reason is because I think there was a misconception that, no one's going to ever find this. It's hidden, it's mine. No one knows who it is, but everything is traceable. Just because you're not receiving a 1099 from your crypto exchange or your wallet address doesn't mean that it's not reportable as either business income. If you don't have, you still have the same gift tax filings. You still have to do the same gain and loss calculation, which is really, we're going to give simple examples today, but having a tax software like Zenledger becomes pivotal in tracking all of these things. To your, what was the other part you mentioned with gifting and the questions?
No, I think you answered it perfectly. I think what has been fascinating is to look at kind of the progression in the history where, right, the Bitcoin white paper started with, right, even the title, peer-to-peer type transaction. And now you have many intermediaries which now introduce flows that you must understand. But I think of that kind of, let's say, progression, one that the crypto community has kind of tried to hold on to is that this notion of anonymity.
Yeah.
And so what you're saying is regulators and governments are effectively looking to uncover who is reporting, who's compliant. And that's where Zenledger steps in. We know the pain points of trying to pull together various transactions, whether airdrops, NFTs, DeFi, various wallets, exchanges. And so can you talk about the Tax Pro offering and the software solutions that are effectively helping not only businesses do it themselves, but also when they come to you, how you can help?
Sure. Yeah. And Zenledger does a great job with the Tax Pro suite. So, if you're a CPA listening to this and you want to get into helping your clients with crypto and not just saying, oh, I don't do it. I encourage you to spend the time and, exploring Zenledger, because you can have multiple clients in there on the dashboard and help manage their crypto taxes. If you're a business and trying to do it, you probably come here because you want to understand it. There's a lot of things to touch on. The biggest thing with Zenledger is when you're using multiple exchanges and wallets. These wallets and, let's say you use MetaMask and Coinbase are two of the main examples that I see in practice. When you send crypto to and from those wallets, or you send crypto, you buy an NFT or you do DeFi and then you send it back to Coinbase, those two platforms don't talk to each other. They don't know your cost basis. So you may get some kind of a tax report from these platforms, but it's not accurate. Zenledger is great in combining everything and tracking your basis and filing it in the most optimal way, which is first in, first out, last in, first out, or highest in, first out. So it tracks your cost basis across multiple wallets and exchanges. You upload it all to one place. Your transactions get organized by timestamp, so you can do the proper categorization and the proper reporting, whether it's income, whether it's trading activity, whether it's gifting crypto. And Zenledger does do a good job of getting into the complexities of, okay, you need to file certain forms if you have a charitable donation. If it's over $5,000, there's certain forms you have to file. So the theme I think you were starting to touch on too is I find tax regulation on crypto and NFTs is trying to fit a square peg in a round hole, because sometimes, we have these old rules and the leading authority guidance is a 2014 notice from the IRS as to what rules to follow. And those in the crypto space may not understand that when they buy an NFT, let's say, and it's a ticket, they may think that's a business expense, but the IRS looks at that otherwise. It's property subject to capital gains and losses. So you kind of have to, you need the knowledge of what the current IRS rules are for traditional property, and also a little bit of knowledge on crypto, kind of be in the space, exploring in the space, buying some crypto, buying some NFTs, really understand the nature of what the average person is doing with crypto, whether business or personal, and then kind of bridging the gap, which, Zenledger is pivotal to. We couldn't do our jobs if we didn't have a tax software to do this. It it would spend, days just to get one person's crypto done, matching up the current pricing and rerunning different cost basis scenarios.
Well, we appreciate you as a partner. And I think you touched on a few things that I think I can simply touch on again and emphasize, which is the term cryptocurrency is effectively a misnomer in terms of the tax treatment. Currency, FX, foreign exchange flows would not be taxed in the same manner if you bought and sold them. So users and businesses in particular must be aware of that, because if you view it as a currency, then that non-compliance seems quite well-meaning and seems like, well, it's a currency, but actually, to your point, is treated as property. And so those distinctions are pretty important if you think about compliance. As we know, the IRS has said that they are beefing up their attention. And there's recent, in addition to the 2014 kind of first clarification from the IRS, there are a lot of comments and a lot of, let's say, recent focuses from the SEC that have effectively kind of even said that more than just property, cryptocurrency could be viewed more broadly as securities.
Right.
And so talking, let's also go back and touch on another point you mentioned, which is a bit more finance speak and tax speak, if you will, FIFO, LIFO, HIFO. When platforms, let's say in general, offer HIFO or LIFO or FIFO, first in, first out, last in, first out, highest in, first out, what should a business owner be thinking about? And especially if they have not been treating their assets or reporting in one respect, and now they need to shift gears, how do they do that? And when they come to you, like what advice do you give?
Yeah, so the first advice I would give them is definitely let's get started with filing, and let's go through the years and see what years you had an obligation to file. Because to your first point, maybe we'll get some updated regulation, maybe they'll clarify certain things and make it less rigid in the property tax structure that we currently have. And there are advantages to the way it's currently set up as well. It's not all bad news for taxpayers and businesses. But you can't bank on the IRS or the SEC or Congress passing regulations. Taxes are due each year, and you got to fulfill your filing requirements. I was in an AICPA continuing education course, and they said the number one area they're going to crack down on is cryptocurrency compliance. So this is an absolute must area for people to address. They can't just ignore it. They can't ignore that first question. In terms of maximizing your cost method, that's something where with ZenLedger, whether you're doing it yourself or if they were my client, we run through their calculation and we're able to toggle between all of those methods once we're done to give the client the optimal, cost basis method. Usually HIFO, highest in, first out, is the most optimal for most clients. Okay,
that's great to hear, and it's one that we think folks should definitely be aware of. The highest in, first out is the method that can maximize your situation. Are there times where a business owner should think about other than the just highest kind of return?
Yeah. So caveat to the highest in, first out, you need to have the proper reporting and specify which asset you are selling. So that's another thing ZenLedger does, is on the 8949, when it prints out the detail, which is the support to your total gain loss on Schedule D, it shows under that method what property, what crypto, what NFT you're disposing of. And then, in terms of every, FIFO, if you want to hold it for longer, if you want to pay less tax later on, FIFO might be an option to consider. And it really just comes down a lot to, I think, record keeping and, talking to the client, deciding, what's your game plan? Do you want to hold this for a while? Are you trying to, maximize tax harvest short-term losses to offset, current year. Maybe it's an NFT project and they mint it out a lot, and they need to have some expenses to offset that, some of that revenue from tax loss harvesting perspective, so they can keep more of their money and invest it. Or maybe they know they're going to have some windfall down the road and they want to conserve losses and use them later on. So that's something, that's a good tax planning strategy within our current set of rules that we can use for businesses or individuals when it comes to cost basis methods.
So you touched on tax loss harvesting, which is not necessarily or generally relevant in January or February of the next year, but due to the bankruptcies of FTX, BlockFi, folks are still trying to get clarity on recoveries and what values of assets were in that bankruptcy. Can you talk about best practices or even how to navigate these uncertain waters? Although it's a new tax year, folks are still looking back in time, which is something that is not as common in past years as it has been for 2022.
Right. Yeah, it's unfortunate. So I'm not an attorney, but you can write off scams, and there's a fine line here, but you can't deduct thefts and casualty losses. So that's something to consider when going through one of these kind of catastrophes with FTX or the Luna collapse, and so many others. But there was a lot of losses in 2022, and if you were invested in 2021, you were down big. And there's no, under the current rules, one advantage is there appears to be no wash sale rule. So, let's say something is fluctuating, and if you're in crypto, the markets move a lot. You can be very proactive in your tax strategy by selling and rebuying throughout the year and not just saving it all for the end of the year, which might be, I think that's what you were trying to touch on.
Absolutely. And especially in terms of IRS tax treatment. If, for example, I had a small portfolio in FTX and I don't know right now what the disposition of that is, should I write that loss off? Is that something I can do tax wise, or is it something I have to, since I don't know, I have to wait?
Well, yeah, it's questionable. Again, not an expert on the legality wise of what is technically scam and theft, what FTX did. But from my perspective, it did seem like a scam. You were told that your money was going to be in your account, and it wasn't, and the company went under. So from my perspective, a practical approach would be writing off as a loss what was in your account at that time that you last had access to and seeing it. And in the event you are able to get 10 cents on the dollar for whatever money you recover, then you can report it as income in the year that you get paid out for it, which we're going to be here for a little while that unfolds in court.
Yeah, it is unfortunate, but that playbook and that advice, although not legal advice, I think is super helpful and provides some good clarity to folks. So we hope that folks will businesses reach out to you and bring these situations. I know they're kind of embarrassed, right, that this all happened, or that they were effectively scammed, which I agree with you. It does feel that way, and with the SEC filings, there's been a pretty solid accusation of fraud. Folks should try to make sure that they credibly use experts like yourself in terms of tax, the tax sector, and you understand the tax treatment. Therefore, they can at least have some sort of opinion that is based in real reasoning. And if the IRS asks later, why did you treat an asset as such? Then, as you mentioned, your example, you can come forward and with that income, you can actually state that income that is higher than what you've written off. So I think that's a great approach.
Right. Yeah, it's with the IRS, it's all about being ordinary and reasonable. Now, there's plenty of tax lawyers out there who they handle all this stuff when it comes to like FTX and what went on. But clients have come to me with a lot of these situations in the past year, and I encourage them. I give them the full disclosure, same way I did to you. And chances are, if you're in a loss already for 2022, which most people are, you want to claim any FTX loss or Luna loss in the year. You can't then claim it on 2023. You have to claim it in the year that it happened. And then, like you said, later on, if you are fortunate enough to get paid, it'll be ordinary income in the year receipt, but it'll be a capital loss that gets carried forward to offset future capital gains for any amounts that you did lose in any of these scams like FTX. You can use $3,000 of that each year against your ordinary income, and then the rest of the capital loss gets carried forward to offset future capital gains from stocks, crypto, and other property.
Very important points. I want to shift gears a bit and ask you, simply because you have a lot of folks that show up with kind of a lot of pieces of paper, a lot of kind of files, and they don't know how to organize themselves or get their house in order. Can you talk about kind of best practices to make sure that, one, it's cost efficient for clients when they show up, and they also have what you need to be efficient and help them file?
So that's one thing too that is really great about the platform is it allows clients to either share a CSV file with all of their raw transaction history or their public wallet address, which if you think about the usual tax process with clients, there's a lot more sensitive information being shared. These documents are either a public wallet address or just raw data with no name on it. So it's a lot more comforting for clients to work with their CPA or professional like myself, because you can provide them that transaction history or just the public address and provide some context to your CPA. Tell them what you did throughout the year. Were you strictly trading? Did you receive some income in crypto? If so, when were those dates? Because what we do is we go through it all. And if there's missing sources or missing cost basis, Zenledger points that out to us. So that's then our opportunity to follow up and say, hey, there's a missing cost basis here. We might have a missing wallet. It looks like it doesn't make sense how you are selling something that never came in to your possession in the first place. Then we're able to follow up and ask some questions and see maybe you had a Robinhood account that we didn't account for or a different wallet.
I've definitely been in that boat where I thought I had everything covered and had integrated all of my wallets and exchanges. And sure enough, there was some NFT that I wanted or thought was cool, and then it's missing. I transferred Ethereum to fund a new wallet, and sure enough, there are these gaps. And so
and that includes your cold storage too, your Ledger wallet. You want to make sure that's linked as well. This way, any external transfers to your Ledger is not shown as a sale. You want to make sure that gets categorized properly as a self-transfer, which are the only non-taxable event really in the world of crypto.
Because that's a good call out. That's a great call out, because what we know is treatment varies upon the situation, and a transfer is potentially a sale, but could not be a sale. And so,
right. Yeah, it's a very gray area in that sense.
Yeah, and so being vigilant about those transactions, I know it's, in the sense, right, stock trading is kind of fire and forget. You buy it, you sell, and if you have various options, right, you might go that direction. But crypto has effectively evolved and grown such as a space that I think regulation is caught up to try to just label different flows. And I think that labeling will evolve over time and there will be more clarity.
I think so too. I think hopefully what we'll see is maybe some regulation on the nature of the crypto, not just lumping NFTs, crypto, DeFi all into property. If you get a Knicks ticket and it's an NFT, and then you sell it later on, you got to go run capital gains and losses on that. What if that was just a business expense for your business? You happen to take a client out, something like that, or you went to a conference rather, which is a deductible expense, and that was a ticket. So there definitely we definitely need to get that regulation there. 100%. I couldn't agree more on that. And the other thing that you were touching on too is crypto to crypto trades, and sending crypto to somebody else. You have to consider all that, because those are taxable events. If you're sending it to your friend, could be considered a sale, and you want to recognize the fair market value at that date is technically your sale proceeds, which can be a little confusing to people if you're trading one crypto to another or sending one crypto to another person and you're not actually receiving US dollars. You still have to figure your gain or loss based on the value at that date. Same with buying an NFT. That's the biggest thing I've been trying to pound the table with and tell people is, hey, you might have bought Ethereum, you might have purchased an NFT, but that is technically a sale on your Ethereum. You have 3 transactions that basically occurred. You have the sale of your Ethereum, you have the cost basis now in your NFT, and you have a fee in Ethereum that is happening as well. So there's a lot, and that's just one small example. And we all know most people have more than just one simple example.
Yeah, that's all touching on pain points that are not necessarily perceived at the start of a transaction.
Right.
And if we talk about DeFi, then depending on the platform and the type of flows, yield farming, et cetera, you could find yourself with hundreds of thousands of transactions. And so I think it's important for users to understand that one trade in a kind of view doesn't necessarily mean it's one transaction.
Right. 100%. And that's an area where this can lead to time too at the end of the year. Most people don't think about that at the start of their first trade. Most people don't think about their obligations until the end of the year. So if you're looking at this thinking, oh man, I got to do 2022 and you have a lot of work to do, get started on 2023, especially if you're doing it yourself. Stick with it once a month, the same you would with your business books. Reconcile what's in your Zen Ledger account to what went on that month. If there's any missing cost basis, make sure you get that in there, because it's a lot harder to look back 12 months later and try and remember what you did.
Absolutely. Playbook points. So, Justin, as we get close to wrapping it up, I wanted to ask you, what are your takeaway points in terms of customers, businesses being ready to file, making sure that you can help them as much as possible and get folks what they deserve, which is an accurate filing on time and funds back if they are deserving of refunds, et cetera?
Yeah, well, I think people this year, I've been finding they are ready to file and they are ready to get moving, because most people did have a loss in 2022. So you can claim that $3,000 loss if up to $3,000 against your other income, which depending on your tax rate, is a sizable amount. So I would encourage everyone to, get started, get their exchanges and their wallets either uploaded or over to your CPA so they can get started working on that, to include that in your return. Be proactive about it. Be proactive about getting it done early, so you don't have to extend or you face underpayment penalties on your extension. And be proactive with 2023. The best, doing a tax return is not as effective as tax planning throughout the year. That's really where you can use all the different tax laws to your advantage, especially to your business's advantage, and really go ahead and, save some money by using the tax code to your advantage.
Words of wisdom. Thanks, Justin.
Thanks, Jonte. This was great. Pleasure to be here with you. Thank you.
Speak soon.